Assalamu alaikum. Good evening. Yesterday we started discussion on International Financial Reporting Standard 15, and we completed a substantial part of the standard, and but we could not cover 100% of the material which we planned to cover during yesterday's session. Due to some technical interruption and because we have taken a lot of questions yesterday, but that area is important, so that's why yesterday we decided to take up the remaining area in the start of this consolidation session. After completion of IFRS 15, we shall start discussion of IFRS 10 and followed by IFRS 3. But IFRS 3, we will be very practical on that. We will start with the revision of like basic consolidation concepts and move to like complex group and disposal of subsidiaries. Of course, of course all this discussion related to consolidation will continue and will end tomorrow, 7 o'clock. Okay, step number 5. In order to recognize a revenue, we learned that the requirements given in 5 steps must be met. Step number 1 was there should be a contract. Step number 2 was like we should identify the performance obligation. Step number 3 was determine the transaction price, and step number 4 was allocation of that transaction price among various performance obligations. And now comes to the step number 5, and that is basically we shall only be recognizing the revenue if performance obligation is satisfied. Mean the control of the asset, of the goods or the services is transferred. An asset is transferred when or as the customer obtains control of that asset. Control of an asset refers to the ability to direct the use of and obtain substantially all of the remaining benefits from the asset. Control includes the ability to prevent other entities from directing the use of and obtaining the benefits from an asset. So this was the basic criteria. Linked to this, we can use the example of a situation where there is a repurchase option. There you have to carefully analyze the repurchase terms and condition so that you could decide about whether the control has been transferred or not. Like repurchase agreements could be of 3 types. Number 1, an entity has obligation to repurchase the asset. This means this is compulsory for the organization to repurchase the asset. Second is the entity has the right to repurchase the asset, not compulsion. It has an option. If entity intends to buy, entity has the right to buy, but there is no compulsion in case of second. In case of third, an entity must repurchase the asset if requested to do so by the customer. So here entity does not have the right to repurchase, and the right is transferred to the customer. Now here we must be very careful because control issue involves in all these 3 situations. So what should we do in this situation? Like in case of where if you find that the repurchase price is below the original selling price, if repurchase price will be given in the contract, If that repurchase price is below the original selling price, then apply International Financial Reporting Standard 16. Or if the repurchase price is equal to or greater than the original selling price, then this is purely a financing arrangement. Means the other party has given you a loan, and for that loan they have taken your asset as a collateral. So this is purely a financing arrangement. So what should be like? We can understand it with the help of this example. An entity enters into a contract with a customer for the sale of a tangible asset on 1st January 2007 for $1 million. The contract includes a put option. Put option means right to sell, that obliges the entity to repurchase the asset at the customer's request. This is the third situation. Number one was forward agreement, number two was call option, and number three is put option. And who is the seller of this put option? Customer is the seller, and entity is the writer. At the customer request for 900,000 on or before 31st December 2007, at which time the market value is expected to be 750,000. So what should be the solution for this? See, the customer has the incentive to sell the asset back to the entity. Why? As per agreement, customer will be able to sell this asset back to the entity at a price of $900,000, whereas price in the open market is expected to be $750,000. Sorry. This means that the control does not pass to the customer, since the customer will be exercising the put option. This limits its ability to use or obtain benefit from this. So in this situation, in case of put option, control is in fact you will have to analyze the put option. If put option is such that this will give the benefit to the customer of returning that particular asset, so this means he will be exercising that option. So this depicts that control is not transferred. So this means this will not be treated as a sale of that asset. This will be treated under IFRS 16. Sorry, difference of 100,000, like we sold it apparently for 1 million and we are buying it back for 900,000. This difference will be accounted for as payments under operating lease. Then is small example. An entity enters into a contract with a customer for the sale of a tangible asset on 1st January 2007 for 1 million. The contract includes a call option that gives the entity the right to repurchase the asset for 1.1 million on or before 31st December 2007. Again, in this situation, control is not transferred, because repurchase option means that it is limited in its ability to use and obtain benefit from the asset. So this is financing arrangement for the entity. The entity continues to recognize the asset and recognizes the cash received as a financial liability. The difference of 0.1 million is recognized as an interest expense. If on 31st December 2007, the option lapsed unexercised, the customer now obtains control of the asset. The entity will de-recognize the asset and recognize the revenue of 1.1 million. So this is all about the control. So transfer of control is important. So especially in case of repurchase options, you will have to analyze the repurchase terms and conditions carefully, so that you could rightly decide whether the transaction will be treated under IFRS 16, or this is a financing arrangement, or this is a real sale. Okay. Now, if say control is control is transferred. Now the next question is, okay, how the control is being transferred? Is it being transferred over a time or at a point in time? A performance obligation is satisfied at a point in time unless it meets one of the following criteria, in which case it is deemed to be as satisfied over time. Mean if any of the following criteria is met, then performance obligation will be satisfied over time, over a period of time. Otherwise, in all other situation, that performance obligation will be satisfied at a point in time. So this is very important for the construction companies, because previously we were used to account for almost all construction contract as if the performance obligation is being satisfied over a time. Now the situation is a little different, a little more prescriptive, more clear. Though substance was there, but normally construction contracts was being treated like as if they are being satisfied over a period of time. But now even you will have to consider for those contracts, rather for all contracts, you will have to consider this criteria before deciding about the pattern of the satisfaction of the performance obligation. Okay, we can look at it one by one with the help of example. I already sent you people examples. Like first is, the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. The simplest example is the services of mine, the services of a trainer. You are consuming these services as I am providing these services. This is the simplest example. And for more technical example, go to example number 6 given in the handouts for participant, IFRS 15. It should be here. Can you ask him for this?
I have already done it.
So ask him if he can do a little quickly, so this will be beneficial. Okay, example number 6. Example number 6. An entity enters into a contract. Thank you very much. To provide monthly payroll processing services to a customer for 1 year. The performance obligation is satisfied over time because the customer simultaneously receives and consumes the benefits of the entity's performance in processing each payroll transaction as and when each transaction is processed. The fact that another entity would not need to re-perform payroll processing services for the service that the entity has provided to date also demonstrate that the customer simultaneously receives and consumes the benefits of the entity's performance as the entity performs. The entity recognizes revenue over time by measuring its progress towards complete satisfaction of that performance obligation. Mean because this criteria is being met, so this service will be, performance obligation related to this service will be satisfied over a period of time. Now the second point is, or the second condition could be, second is the entity's performance obligation, the entity's performance create, okay, just 1 minute because I cannot properly see the material given over there. The entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. Now let's have a look at example number 7. Example number 7 is, An entity, a construction company, enters into a contract to construct a commercial building for a customer on customer-owned land. The entity accounts for the promised bundle of goods and services as a single performance obligation satisfied over time because the customer controls the building during construction. So this is the second example. Then the third one is the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. This is again very important. So we can use example number 8 to in order to discuss this point. Example number 8 is this is example number 8. Example number 8 is an entity enters into a contract with a customer, a government agency, to build a specialized satellite. The design and construction of each satellite differ substantially on the basis of each customer's needs and the type of technology that is incorporated into the satellite. As part of that assessment, the entity considers whether the satellite in its completed state will have an alternative use to the entity. Although the contract does not preclude the entity from directing the completed satellite to another customer, the entity would incur significant cost. This is an indication. If you have to incur significant cost to make it usable for another purpose, for another client, this indicates that this asset has got no alternative use. Significant cost to rework the design and function of the satellite to direct that asset to another customer. Consequently, the asset has no alternative use to the entity because the customer-specific design of the satellite limits the entity's partial ability to readily direct the satellite to another customer. For the entity's performance obligation to be satisfied over time, when building the satellite, also requires the entity to have an enforceable right to payment for performance completed to date. So these were the examples related to point number 3. Okay. So this was basically step number 5. If any of these conditions meet, then performance will be satisfied over time, otherwise at a point in time. In the start of yesterday session, we already discussed at length the difference between International Accounting Standard 18, IFRS 15. Rather, I discussed this area to greater extent than the material given over here. If you want to revise that area, you can listen to the recording of yesterday's session. I covered with very detailed right at the start of the session what is the difference between this new standard and the not only 18 but also the existing standards related to this area, standards and interpretation. So what is the impact of IFRS 15? Though I covered to some extent its impact as well, but anyway, just to discuss it very quickly again. For straightforward retail transactions, IFRS 15 will have little if any effect on the amount and timing of revenue recognition. For contracts such as long-term service contracts and multi-elements arrangement, it could result in changes either to the amount or to the timing of revenue recognized. IFRS 15 must be applied retrospectively, that is, as if it has always been. We are going to discuss this first time application, tax planning issues where different amounts of revenue will now be recognized in different periods through total may be the same. For example, for telecommunication companies, so these issue will arise. A lot of stakeholder need to be involved, and profit bonuses may be affected because revenue recognition criteria is being changed. So this will definitely affect your profit, and if profit is affected, any bonuses or any covenants related to the profit or the revenue that is going to be affected. So similarly, if in case of bonuses, you will have to talk to your employees, and similarly this will have implications for taxation. So this will have far-reaching implications for like industries like software houses and like airlines and like construction, especially for the construction. Okay, I have already mentioned the most impacted industries, and those are telecom, software development, real estate, and other industries with long-term contracts. Okay, let's have a discussion on the transition. It is better you should note few points, not many. See, Standard has given two options in this regard. Previously, this was not the case. Previously, there was only one option. When we discussed in our last session, there was only one option. Discussions were happening, but nothing was finalized. Now, but at this point in time, Standard has given us two options. We will name it option 1 and option 2. Both options are fairly detailed and helpful in providing some relief on initial application of IFRS 15. So what is the relief? What is the relief? And our discussion will be with the reference of the initial application. Okay, let's use an empty document. Okay. Initial application. Initial application. So initial application date is initial application date is 1st January 2018. This is the initial application date. If we assume our year end is year ending 31st December 2018, and we only provide comparative information, these are few assumptions for our discussion. We are only going to provide comparative information for 1 year only, and that is 2017, and that year is from 1st January 2017 till 31st December 2017. Okay, so when I will mention initial application date, this means 1st January 2018. When I say comparative information or comparative period, so this means I am talking about 2017. Okay. So there could be three situations. there could be three situations for you. Like this is, say, if I change color here, okay. This is, say, 1st January. This is 1st January 2018. Okay. And this is 1st January 2017. And this is 1st January 2016. Then 1st January 2015 and onward. Likewise, 1st January 2019 and onward. See, if I have a contract, which started, in 2007 and ended in 2007, that will fall over here. That will fall within these two brackets. Begins and end in 2017. So if I name it A, okay. Okay, if another situation, I have an old contract which ends somewhere in 2017. Say I name it B contract. Then I have another contract which started somewhere in the past and that will continue in the future. And say I name it contract C. If you just, and there will be contracts which will be starting in 2018. There is no question that the question of initial application will not arise, because you have already started applying this new standard. Of course, all the requirements, all the disclosure requirements, all the recognition measurement requirements of this standard will apply for all the contracts which you will start in 2018 and onward. So we are not, of course, we are not discussing that. Now, what about contract A? Contract A. For contract A, so here I will mention like two options as the standard has given us. Modified approach, mean method option 2. Modified approach. Flexible, one can say it's a flexible approach. So we can say this is method 2, this is allowed by the standard. So you have the option for this. And then there is method 1, which is with, of course, a practical expedient. I will be explaining what is that. Method 1 is like full retrospective full retrospective approach. Full retrospective approach. Okay. So for contract A, if I change the color, for contract A, if you want to apply modified approach, no need to apply IFRS 15. Do not apply. IFRS 15. Do not apply. Okay. And A for this method, of course. Again, here there are two options. One is this: if I make it full retrospective approach. Standard says you can go for full retrospective approach for A because sorry, project A is falling in an year which is our comparative information, but A is starting in 2017 and ending in 2017. Mean that ends before the initial application. So standard has given you three options. Either you should go for the full retrospective application, okay, go for the evaluation and apply this standard, or do not apply IFRS 15 for this A. Mean comparative information will remain unchanged, will be on the basis of your previous practice. Or there could be practical expedient available. And what is that practical expedient? And that is do not restate. Don't restate. Don't restate. Leave it as it is. Mean for completed contracts where the entity has transferred all of the goods or services identified under ISA 11 or 18 and the related interpretations, entities are not required to restate contracts that begin and end within the same annual reporting period. For example, for an entity first applying the standard for a 31st December 2018 year end, contracts entered into and completed in 2017 will not need to be restated. Leave them as it is. Whatever accounting treatment you have done for A, leave them as it is. Don't restate them. And the third one is modified approach. Even you go for that, you can go for that on your initial application. Mean do not apply IFRS 15. In case of A, this and this are the same. There is no difference, in fact. Okay. For the B, for the contract B, B is the contract which is ending before the initial application date. Mean before 1st January 2018, B ended. So what are the options available here? In case of modified approach, again the same. Do not apply. Do not restate. Again the approach is the same. But in case of method 1, for completed contracts, entities are not required to restate any contract that was completed at the beginning of the earliest period presented. For example, for an entity first applying the standard for a 31st December year end and presenting comparative information for the year ended 31st December 2017 only, contracts completed by 31st December 2016 do not need to be re-evaluated. So here again you have two options: go for the full retrospective application, or do not go for the restatement. Don't re-evaluate them. I need to make a small correction in case of B, because I mentioned over here this is ending in 2017. No, it is ending before 1st January 2017. Before 1st January 2017. Now comes to the C. For C, adjust opening balances of each affected component of equity at the date of initial application. Mean, adjust opening balances. Adjust opening balances mean 1st January 2018 for this contract, for C contract. Only. This means no change in 2017, which is comparative information. Comparative information. So here, if you go for then you have full retrospective approach. So basically, standard has given you two approaches. Now you can decide yourself which approach you want to apply. Entities can apply standard retrospectively to all comparative periods presented. Under this approach, prior year comparatives are restated with a resulting adjustment to the opening balance of equity in the earliest comparative period. Where this option is chosen, the standard provides a number of optional practical expedients. These are the practical expedients. Mean if it is difficult for you or it is not possible for you, then you can go for this. But standard has provided other option as well. For all period, other option is under the modified approach, the entities can apply standard only from the date of initial application. You can see that in this approach, we are not affecting 2017. Even in case of B, we are not affecting, but in case of C, we are only affecting 2018. We are not affecting comparative information. So this is modified approach. If they choose this option, they will need to adjust the opening balance of equity at the date of initial application, mean on 1st January 2018, but they are not required to adjust prior year comparatives. This means that they do not need to consider contracts that have been completed prior to the date of the initial application. Broadly, the figures reported from the date of initial application will be the same as if the standard had always been applied, but figures for comparative periods will remain on previous basis in case of this approach. When using this approach, entities can elect to apply IFRS 15 retrospectively only to contracts that are not completed contracts at the date of initial application. Of course, situation will vary from company to company. There are some other couple of relaxations. so far as the initial application is concerned, but those will vary from company to company. Mean you can look at your individual company situation, and then you can decide which relaxation is applicable to you people, or whether you want to apply that relaxation or not. So this is the relaxation given by the standard recently. Okay, this was all about International Financial Reporting Standard 15. If we have any question, I can quickly answer those questions. Mr. Kham, can you please help me in this regard?
So far, no question is there.
Okay, thank you very much. Even if you have any question, please feel free to write us. But once we started consolidation, so we will not be in a position to answer question related to IFRS 15, and then we will be, and the recording is available. You can look at those recording in case you want to repeat something from the material we discussed, and the recording of like my write-up will also be available. Like I have given over here one, I filled one empty document here, so that will also be sent to you people, and you can hear the recording and then see this calculation. Hopefully this will guide you while applying this standard initially. Okay. In consolidation,
Sir, Burhanuddin asked, what about my yesterday question? The trainer promised to discuss today.
Burhan, you are very right. Actually, Burhan, you used to write me regularly. So this morning I checked my email box just to see whether I have received anything from your side, so that I could get a good idea of your thinking. But anyway, you please revise your question, repeat your question, write your question, but write your question in one go. So I will try to answer that question now. Please write your question.
Seems like he's writing the question.
Okay. If we have any other question, then we can. Okay, fine.
He's saying he will send you through email.
Okay. Okay, as you like. Okay. Now,
Yusuf is there. He's saying, please share which IFRS are applicable completely in Pakistan and which are applied partially.
Usman, we shall be conducting a short session of updation. So there I will cover, inshallah ta'ala, this area, that so that people from different region can note that when and which standard will be applicable to their particular areas, specific areas. Okay. Okay, now we can move to the consolidation, our new standard, a new area. Basically, I should not say standard because a number of standards are involved in this area. So, thank you very much, and thank you for those people who bear with us from the start of this session, because they were sitting with us for the consolidation, and we are really thankful to those people for bearing with us. But anyway, I shall try to cover their area which they are looking for from now onward. See, in consolidation, first of all, we shall be discussing International Financial Reporting Standard 10. First, we shall be discussing this standard. Then we shall start with the revision of basic consolidation concepts with the help of small illustrations. Numerous small illustrations. After each concept, I have selected small illustration from my book, IFRS Application Guide. normally most of my material is taken from that book. Similarly, consolidation material is also taken from that book. For exam scope question or larger scenario, you can refer to that book. Okay, then after basic consolidation, we shall move to concepts like complex group. Then we will move to the disposal of subsidiaries, and there we will try to cover those areas so far as the concept is concerned with the help of relevant small illustrations. During this session, I am afraid we cannot discuss lengthy scenarios, but all these illustrations, most of these illustrations are taken from lengthy scenarios, in fact. Because what is lengthy scenarios? Lengthy scenario is made up of many small scenarios. And if you are able to address each of that small scenario perfectly, then you will be able to compile the whole small concepts to answer your big big scenario. But practically, of course, if your concepts are clear and you by utilizing those concepts, you tackle each of the step involved carefully and perfectly, then you can handle that practical situation as well. Okay. International Financial Reporting Standard 10, Consolidated Financial Statement. See, the objective of this standard is to establish the principles for the presentation and preparation of consolidated financial statement when an entity controls one or more other entities. In other words, if an entity controls one or more other entities, then this standard guides us so far as the presentation and preparation of the financial statement, consolidated financial statement are concerned. So this means control is important. See, to meet this objective, this standard requires the parent that controls one or more entities, means subsidiaries, to present consolidated financial statement, defines the principles of control, and establish control as the basis for consolidation. If there is no control, you cannot prepare consolidated financial statement. So control is the basic principle, and this standard sets out how to apply the principle of control to identify whether an investor controls an investee and therefore must consolidate the investee, sets out the accounting requirements for the preparation of the consolidated financial statement, and defines an investment entity. This is important for those people who studied maybe 4, 5, 6 years back or maybe 3 years back. So this is something important for them. Defines an investment entity and sets out an exception to consolidating particular subsidiaries of an investment entity. Okay, so let's discuss them one by one. First of all, we start with the scope. Here in scope, an entity that is a parent shall present consolidated financial statement, except in the following situations. Or a parent need not to present consolidated financial statement if all of the following conditions hold. Number one, the parent itself is a subsidiary and owners do not object. They have been informed and they do not object. So this is one, mean parents is itself a wholly owned subsidiary, or it is a parent owned, partially owned subsidiary of another entity, and its other owners, including those not otherwise entitled to vote, have been informed about and do not object to the parent not presenting consolidated financial statement. This is one. Its securities are not publicly traded. It is not in the process of issuing securities in the public securities markets, and its ultimate or intermediate parent publishes consolidated financial statements that comply with international financial reporting standards. If all of the following conditions hold, then that parent need not to present consolidated financial statements. Okay. Further, this standard will not be applied to post-employment benefit plan, long-term employment benefit plan. These will be covered under International Accounting Standard 19. Then further, a parent that is an investment entity shall not present consolidated financial statement. Investment entity. Okay. So these are the parents, or these are the transactions which will not be covered by International Financial Reporting Standard 10. Okay, as we discussed, control is the key. If an entity controls one or more other entities, only then this entity will prepare consolidated financial statement. This means understanding of control is important. See, as per International Financial Reporting Standard 10, an entity controls the other entities if and only if it has all of the following. Number one, power over the investee, exposure to or rights to variable returns from its involvement with investing, and the ability to use its power over the investee to affect the amount of the investor's return. So these three conditions should be there. If these are there, then control is there. See, the important point here is control. In most cases, this will involve holding company or parent owning a majority of the ordinary shares in the subsidiary, to which normal voting rights are attached. But there are circumstances when parent may not may only own minority of the voting power in the subsidiary, but the parent still has control. See, so if there are changes to one or more of these three elements of control, then an investor should reassess whether it controls an investee. See, power as defined under key terms can be obtained directly from ownership of the majority of the voting rights and can be derived from other rights, such as I mentioned earlier, holding majority share is normally the way of controlling an organization. But this is not compulsory. Sometimes an entity holds only a minority of the voting power, but that is still controls the other entities. This situation could arise, for example, if an entity has rights to appoint, resign, or remove key management personnel who can direct the relevant activities. Rights to appoint or remove another entity that directs the relevant entities. Rights to direct the investee to enter into or veto changes to transactions for the benefit of the investor. Other rights such as those specified in a management contract. So you need to see, is the entity able to direct the relative entities either directly or through some other party, and that party could be like another entity or could be some individual as well. And similarly, the right to direct relevant activities could be as a result of some agreement. So you need to consider these factors if control is not apparently there. Okay, let's understand this with the help of a couple of examples. So let's discuss first this example. A Limited holds 40% of the voting rights of B Limited, and 12 other investors each hold 5% of the voting rights of B Limited. A shareholder agreement grants A Limited the rights to appoint, remove, and set the remuneration of management responsible for directing the relevant activities. To change the agreement, a 2/3 majority vote of the shareholders is required. To date, A Limited has not exercised its rights with regard to the management or activities of B Limited. Explain whether A Limited should consolidate B Limited in accordance with IFRS 10. You can try to figure out, and we can pop up a small question whereby you can select the right option.
Okay, the question.
Though we have just started the consolidation, but we are basically refreshing those concepts. I mean, we are not new to that, so that taking advantage of that situation, taking advantage of your mashallah, your background. So that's why I want you to decide about it, and we shall be popping up a question should it yes or no.
So what should be the question?
After 1 minute, write the same question which is mentioned under requirement, and the option will be yes or no.
I have launched the question.
Okay, you people have just 30 seconds because you need to click only yes or no. My slides are available on GoToWebinar. You can download them if you just want to relook at the example 1. So there you can reread this example before selecting your option.
These handouts are also available at Google Doc.
Okay.
Yesterday we have shared the link.
Give them 30 seconds more.
Okay. So for only 15% people.
Please, response. Wake up. We started the consolidation. Wake up and answer this. And if someone has not seen is unable to see this example, please download your slides from GoToWebinar and look at slide number 6, where this example is given.
Okay, attention to all attendees. I am going to close this poll question. Anyone who has left with the answers should submit within a blink of an eye, I must say. Okay, so here I close that. 77% people saying yes, and 23% people are saying no.
77% people are correct. But for 23%, please wake up. Very simple. See, if you just look at it, it is mentioned over here, like you can see from here, it is mentioned over here, though A Limited holds only 40%, but there is an agreement which gives A Limited the rights to appoint, remove, and set the remuneration of management responsible for directing the relevant activities. See, the absolute size of the A Limited's holding and the relevant size of the other shareholders alone are not conclusive in determining whether the investor has rights sufficient to give it power. However, the fact that A Limited has a contractual rights to appoint. If we go back to the last slide, you can see that we discussed this point. It is given over here, like rights to appoint. This point number A. Even if you do not hold majority shareholding, but you have this right, this means you are controlling that entity. If you are controlling that entity, then your financial statement will be consolidated. You will be consolidating that subsidiary. So this is our example number 1. Okay, I give another opportunity to 23%. Of course, everybody should answer, but especially for 23% to make this time the right choice. This example is TP company holds 45% of the voting rights of XYZ company. ABC company and MN company each holds 26% of the voting rights of XYZ company. The remaining voting rights are held by 3 other shareholders, each holding 1%. There are no other arrangements that affect decision making. Explain whether TP should consolidate XYZ company in accordance with IFRS 10. Again, please, those members who have not yet downloaded these slides, please download them so that this should be in front of you while you respond to the pop-up question. So you have 1 minute to ponder upon this example 2. Thereafter, we shall be popping up question based on the requirement of this example.
This example is on page number 7 of the slide.
Slide number 7, rather.
I have also shared the Google Doc link that is available for all of our attendees. From there, they can download all the handouts. The handouts are available there. All the handouts are available there in relation to our past webinars and the webinar that we are running today. Thanks.
Okay, I think we should end of a question.
We have not given it in our pop-up question. Rather, I was expecting that they have to retrieve from their slides and then we will.
Okay, now pop up that question.
Okay.
Because even if they have not done, they can see they have.
I'm going to pop it up now. The question has been launched. So
Please wake up, please participate.
Only 30 seconds left. All the attendees are requested to participate. So we have achieved only 17% people who have voted for this poll question. Ten seconds left now. Okay, so I'm going to close this question. You have a few seconds left to submit your answers. Okay, I'm going to close now. Thank you, everyone. We have 53% people saying yes, and 47% people are saying no.
47% are correct. Please wake up. See, this situation is in front of you. This situation is in front of you, and we can see that. TP company holds 45% of the voting rights. There is no other arrangements. There is no other arrangement. This means this percentage will be the deciding factor. The other two investors would need to cooperate to be able to prevent TP company from directing the relevant activities of the XYZ. So this means TP company is not controlling XYZ company. So please wake up. Because while discussing control, we said that, see, if there is no other arrangement, simply keep it in your mind, if there is no other arrangement, then the percentage shareholding will be the deciding factor. Like if an entity holds majority of the voting rights, then that entity will be controlling, provided there is no other arrangement. If there are other arrangements, like as we have seen on this slide, A, B, C, or D, then of course, whether they hold majority of shares or not, then they will be controlling the other entity. So please wake up. Okay.
Some people are sending their questions.
Yes, please.
If a private limited company wholly or partially owned by any other company, but its securities are not publicly traded, is it necessary for it to present consolidated financial statements? However, all the criteria is not met for not presenting the consolidated financial statements, as you mentioned in your first slide, Mr. Sakib Ali Rashidi.
Sakib, if all conditions are there, what are the conditions? Simplest conditions are its securities are not listed. It is not in the process of issuing of securities for listing. Number 3, its ultimate parent or intermediate parent is issuing consolidated financial statement as per IFRS. And owners of this entity do not object to it. Then of course they can forego the consolidated financial statement. Next.
Muhammad Iqbal was asking, you mean to say 51% holding?
Yes.
Okay. How can I see yesterday IFRS 15? Okay, it's not.
So it is better, Khayyam, you can say a few words on that. I mean, how can they approach the video and the documents? Because I remember this morning someone contacted with me for the slides and the videos and the other material, even related to the previous webinar. So I hope Khayyam is the right
Previous
person to answer
webinars
this.
are available on Vimeo, and for current webinars that we have run this year, we will be uploading it in a day or two on Vimeo and YouTube channels. So people will be able to access all the videos from there. And Google Doc link have already been shared with them. We will be sending that link through email as well.
Okay, so I think by the end of session, it is preferable that we should share the YouTube and Vimeo links as well. I mean, our like channel address as well, so that though it will not be very difficult, but it will be easy for them to find out the latest video
Yes.
related to this session. Okay, next.
No more
Okay.
questions.
Okay, now example. No, come to another example. This is to some extent tricky, so I shall be discussing it myself. See, White, a public company, is preparing its financial statement for the year ended 31st December 2026. The finance director of the White has set up a company, Yellow, through which White conducts its investment activities. White has paid 400 million to Yellow during the year, and this has been included in dividend paid. The money was invested in specified portfolio of investment. 95% of the profits and 100% of the losses in the specified portfolio of the investment are transferred to White. An investment manager has charged for the company's investment and owns all of the share capital of Yellow. An agreement between the investment manager and the White sets out the operating guidelines and prohibits the investment manager from obtaining access to the investment for managers' benefits. Explain whether Yellow should be consolidated by White in the group financial statement. See here, who owns the share? White directly does not own the shares, but there are other arrangements. Now we will be looking at the other arrangement. See, the important thing is, if there are other arrangements, we will straightforward go to other arrangements. We will study those arrangements to conclude whether the entity is directing the relevant activities or not. See, White has the power to govern the financial and operating policies of Yellow through its operating guidelines. It also has power to prohibit the investment manager from profiting personally from the investments. White is exposed to and has rights to available return from its investment in Yellow, as it receives 95% of the profits and 100% of the losses of Yellow. White therefore controls Yellow, and Yellow should be consolidated. So this is example number 3. Then there are a couple of there are a few more examples, like example number 4. Answer is included within this example. An investor acquires 48% of the voting rights of an investee. The remaining voting rights are held by thousands of shareholders, none individually holding more than 1% of the voting rights. None of the shareholder has any arrangements to consult any of the others or make collective decisions. When assessing proportion of power voting rights to acquire on the basis of relative size of the other shareholding, the investors determined that a 48% interest would be sufficient to give it control. In this case, on the basis of the absolute size of its holding and relative size of the other shareholdings, the investor concludes that it has sufficiently dominant voting interest to meet the power criterion without the need to consider any other evidence of power. See, 48% shares are there. Rest of the shares are widely diversified. None of the shareholders, remaining shareholders, has more than 1% of the shares. So, and there is no other arrangement where they can behave collectively, the other shareholders. So this 48% is an evidence that like they are in a position to control it. So you need to look at the whole situation. Like in an earlier example where entity was holding 45%, and we declared there that, and there was no arrangement like in this case, there we declared it as if it is a subsidiary. Why? Because there are other two shareholders who are like holding 26% each. Only these two can affect the ability of that organization to direct the relevant activities. So this was the reason. This example is taken from standard. Almost all examples are taken from standard. There is another example, example 5. An investor holds a 45% of the voting rights of an investee. 11 other shareholders each hold 5% of the voting rights of the investee. None of the shareholders has contractual arrangement to consult any of the others or make collective decision. In this case, the absolute size of investor holding and relative size of other shareholding alone are not conclusive in determining whether the investor rights sufficient to give it power over the investee. Additional facts and circumstances that may provide evidence that investor has or does not have power shall be considered. So these were a few examples taken from the standard. So you can relook these examples in order to cement your concept so far as decision about control is concerned. Okay, then non-controlling interest, very simple. We know that this standard says a parent shall present non-controlling interest in the consolidated statement of financial position with an equity separately from the equity of the owner of the parent. I mean, this will be the part of the equity, but this will be a separate item from other items related to the owner of parent. Then changes in a parent's ownership interest in a subsidiary that do not result in the parent losing control of the subsidiary are equity transactions, that is transaction with owners in their capacity as owners. I hope sorry, this concept hopefully will appear in some illustration, and this will be automatically illustrated numerically. Then this is the concept which you should keep in mind, especially those people who qualified maybe 3 years before. Like this is the type of property in the entity which is named as investment entity. An investment entity shall not consolidate its subsidiaries or apply IFRS 3 when it obtains control of another entity. Instead, an investment entity shall measure an investment in a subsidiary at fair value through profit or loss in accordance with IFRS. So what is the investment entity? There could be a lengthy discussion on this topic, but from my point of view, this is quite straightforward. This is not difficult. If you just look at the definition, like investment entity is an entity that obtain funds from one or more investors for the purpose of providing those investors with investment management services, then commits to its investor that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both, and measures and evaluates the performance of substantially all of its investment on a fair value basis. So if these three things are there, so then this is an investment entity, and investment entity is not required to consolidate its subsidiaries or apply IFRS 3. Rather, it will be applying International Financial Reporting Standard 9. Consolidation requirements. Again, these requirements will be practically illustrated with the help of numerous illustrations, like parent shall prepare consolidated financial statement using uniform accounting policies for like transactions and other events in a similar circumstances, and consolidation of an investee will begin from the date the investor obtains control of the investee and cease when the investor loses control of the investee. So this was in summary form about International Financial Reporting Standard 10. Now we move to the other standard, other requirements of consolidation. This was the basic. From that standard, what we learned like what are the conditions. If they are there, then we need not to consolidate the financial statements. There we learned like what is control, and control is required in fact for the preparation of the consolidated financial statement, and what are the investment entity, and what is the definition of investment entity, and what are the requirements related to the investment entity. Means you will not be preparing consolidated financial statement in case of investment entity. Okay, now come to the second part of the consolidation. Here, basics of consolidation, consolidation of statement of financial position. I would recommend that you should download handout related to this area, because that handout will have all those illustrations which we will use while discussing the concept of consolidation, in fact. Okay.
Sir, we have a very important question from Saki Rashti.
Yes, sir.
He said, thanks for your answer, but I asked the question because we have been criticized by SACP and our auditors qualified our reports on behalf of not consolidating our financial statements. However, we hold 60% shareholding of another company, and our company is not owned by any other company, but our securities are not traded publicly. All criteria are not met for presenting the consolidation, and as per your answer, we may forego the option of consolidation.
No, Sakib.
So why our report was
No. Sakib, see, sometime when you include a lot of things, this is possible that I may forego. I will ask you one by one. So Sakib, please be attentive. Let me go back to that slide. I will be asking you one by one, and your answer will automatically tell even to you that whether they were correct or not. Okay, if we go back to our earlier slide, Sakib, this was the slide. Okay, now tell me, the situation was you own 60% share in another entity, yes or no?
Sakib, please be quick.
Sakib, yes, okay. Is your company subsidiary of another company, yes or no?
No.
So first criteria is not being met. Okay, B is okay for you people. C could be okay. And D is not applicable because your company has no ultimate parent. Your company has, A and D are not being fulfilled in your case, in your specific case. Because when you told me this question earlier, I suppose perhaps you are already talking about A and B, you are only focusing on B and C. But in your specific situation whereby you are a company and you are holding 60% of another entity, and you decided not to prepare the consolidated financial statement because you people concluded that your securities are not trading, and you are not in the process of issuing those securities in any of the securities market. These two conditions hold, I agree with you, but so far as the A and B is concerned, because if you just go to the first line, if all of the following hold, so in your specific case, A and D do not meet. Sakib, I hope it is clear. Our communication is clear. Sakib, please answer.
Yes.
Okay. Okay. Any other question?
No
Okay,
more.
fine.
He's saying thanks to you.
You're welcome, Sakib. Welcome. Okay, we can go to. Okay, we were discussing the other. Yes, this one. We can have a few minutes break at this point in time, and we shall be resuming from these new slides. Thank you.
So we are going to resume back our session. In the meantime, you are requested to forward your questions if you have any. Thanks.
Thank you. So here are some of the basics, like we normally add all assets and liabilities throughout the group while consolidating, of course with the certain exceptions, and we cancel out an item which appear as an asset in one company and a liability in another company. And then share capital of parent will appear only in consolidated statement of financial position. Share capital of subsidiary will not be shown. Then investment in subsidiary appearing in the parent's financial statement under non-current asset will disappear on consolidation. And in fact, the investment in subsidiaries in parent's financial statement and the share capital of subsidiary are cancelled out in consolidated financial statement. So if we just look at illustration number 6, we can see that here in illustration number 6, this is a very basic example. Here you can see that statement of financial position as at 31st December 2026. Non-current assets, A company, B company, property, plant and equipment, then investment in $40,001 shares in B company. If we just look at it, what is the share capital of B company? And that is $40,001 ordinary shares. This means A company acquired 100% of the B company for 70,000. Then this is the receivable like in the accounts of the A company, and this is receivable from B company. And likewise, you will find here like payable to A company is 2,000 here, and here also 2,000. And then there are other like figures. A company regularly sell goods to its one subsidiary company, B company. A company acquired 100% share capital of B company. Can we move it from here to here? Cannot, huh?
Let me do it for you.
Okay. Prepare the consolidated statement of financial position. Simply, we know that because the date of acquisition of B company is the same when we are required to prepare the consolidated statement of financial position. So here is one small adjustment, and that is like asset will be added into the asset. So this will give us like 35,000, 40,000, and this will give us 80,000. I can use pen over here. So this will, just 1 minute. Let me open this question in front of me. Illustration number 6. When I say illustration number 6, this is basically the reference of the book which I mentioned earlier. Okay, so this will give us 80,000 asset into asset, and then we know that this 70,000 will disappear, and we shall prepare a separate account, cost of investment account, whereby this 70,000 will go as a cost of investment, and against that cost, this we have obtained this share capital. So these two will cancel with each other very simply. So 40,000 will be here because we are requiring this when we are requiring on 31st December when this statement of financial position is being prepared. So there is no like profit. There is no profit related to period after the acquisition. So this is the amount of the share capital, and then we included in this like retained earnings. So this is the net asset we acquired in fact, and its total value is like 69 something. So we acquired it for 59. So goodwill will be I suppose 11,000. Yes. So goodwill will appear here in the consolidated financial statement, 11,000. Then simply add inventory into the inventory. This will give us 28,000. And then receivable will cancel with each other. Here is a receivable and here is a payable. So these will cancel with each other. So we will not mention anything. And then this is 15,000. And then cash at bank when we add up to. So this will give us the total of the asset. And then as we discussed earlier, like share capital of only parent will appear over here. So share capital of parent is 56,000. Then retained earning of parent. Then bank overdraft 3,000, and then payable others because this is cancelled with this receivable. So 4,000 plus 2,000, 6,000. So the total will become 135,000 here, and similarly 135,000 here. So this is the consolidation, 3,000, 6,000. Very straightforward. I think I have mentioned here 56,000. In fact, this is 70,000. So I can use from here razor to raise this 56,000. So I can use pen again over here, and this is in fact 70,000. 56,000 is in fact the retained earnings. So this is the simple start whereby you add asset into the asset, liability into the liability, except this investment in subsidiary will go to the cost of investment account and will not appear in the consolidated. And against this investment, you will transfer the pre-acquisition results, including share capital and other reserves of your subsidiary to this account. The difference will be negative or positive goodwill. The positive goodwill will appear over here, and then for the other assets, because this asset is basically the liability of the subsidiary, so this will cancel. Both will cancel with each other as we have seen on our slide, and the rest of the assets and liability will be added up, and in equity share capital of parent will appear, and then a retained earning of the parent is there, because this was acquired on the date of this is being prepared on the date of acquisition, so no post acquisition results. So these were the principles which we applied on this illustration number 6. These procedures were applied on that. Okay. Now move to the next slide, whereby we can have other procedures. Number 1, parent may not have acquired all the shares of the subsidiary. This raises the issue of non-controlling interest. Very simple. In illustration number 6, parent acquired 100% of the shares of the subsidiary. But if this is not the case, means if parent acquires less than 100% of the shares, the remaining percentage not acquired by the parent will be termed as non-controlling interest. One company may have issued loan stock of which a proportion only is taken up by the other entity. See, the company which has issued the loan stock, that will be the liability for that company. But if that a part of that loan stock is taken by another, like parent or subsidiary, so that will become the investment for that company. But while consolidating, that part will be cancelled from both figures. Then is the intercompany balances may be out of step. So this is important. Like intercompany balances, if there is an intercompany trade, so there will be receivable and payables. In normal circumstances, receivables will either be equal to or greater than accounts payable. In normal circumstances, assuming that there is no mistake, then receivable will always be equal to or greater than the payable if there is no mistake. If this is not the case, then there is a possibility of mistake in the accounts of either company. Okay. Then we discussed techniques to handle like 7 and 8. It is mentioned over here 6.7, 6.8. No, read it as 7 and 8. 7 and 8, uncancelled loan stock will appear as a liability of the group. Mean if like subsidiary has issued loan stock of 50,000. Parent has invested 10,000 within that loan. So 10,000 is basically intercompany. 10,000 will disappear in consolidation from the asset, and similarly 10,000 will disappear from the liabilities of 50,000 while consolidating. This is point number one. Uncancelled balances, of course, in this case 40,000 on the intergroup account represent goods in case of trading. Goods or cash in transit, which it will appear in the consolidated statement of financial position. Okay, we can see another example. Illustration number 7. Illustration number 7. This is illustration. As I mentioned earlier, please make sure you have downloaded it.
I think I must ask all the attendees that please tell us that whether they have downloaded this handout, and I must say all the handouts that are available on the Google Doc link and also available in the handout sections right at the bottom of the Good webinar console panel.
See, in this
Yes.
illustration, okay, fine. Thank you very much for your feedback. In this illustration, you can see that the statement of financial position of Park Company and its subsidiary Saudi Company has been made up to 30th June. Park Company acquired 80% of the ordinary shares and 40% of the loan stock of the Saudi Company on 30th June 2016. When this Saudi Company was acquired, this was acquired on 30th June. This means the date of acquisition and the date the statement of financial position is being prepared are the same. Okay. Non-current assets, then we can see that here you can see that investments in shares. We know that this will disappear and this will go to the cost of investment account. This will not be added up to become the part of the consolidated statement of financial position. And this is the loan stock. This is the loan stock which is issued by Saudi company. If I just come down, so this is the whole picture in front of us. See here, this is the loan stock. This is the loan stock. Out of this loan stock, 20,000 was invested by the Pak company. So what is the common figure between these two? 20,000 is the common figure. 20,000 will cancel from here while consolidating. 20,000 will cancel from here. 20,000 and 20,000 will cancel from here. Minus 20,000. And in the consolidated balance sheet, 0 will appear, or you can ignore it as well. And in front of 12% loan stock, only 30% will appear. Why? Because a part of loan stock, what is that part? 20,000. That 20,000 was financed by the Pak company. And this is the intercompany financing. On consolidation, you will deduct the amount of investment by the other company in that loan stock. And the loan stock will appear in the consolidated statement of financial position after deduction of that intercompany investment. Okay, second, we know that this 105 will go to the cost of investment account. Cost of investment account here like as an investment. So this will also not appear in the consolidated financial statement. If there is no adjustment, then simply add these two assets. So this will give us 220,000. Okay, because we have seen the whole question. It is in front of you as well. So there is no other adjustment. So this means inventories. No, there are goods in transit. Anyway, simply add up receivables. This will give us 70,000. This will give us 70,000. Now again, this is current account with S company because they are trading with each other. Here we will see that what is the amount in these accounts. See, as I discussed earlier, let me raise because I made small wrong line. As I discussed earlier, receivable will always be equal or greater than the payable. Here you can see that receivable is greater. Simply reduce both amount by the lowest amount. Reduce both amount by the lowest amount. And what is the lowest amount among these two? 12,000 is the lowest amount. Reduce this by the 12,000. 12,000. Reduce this amount by the 12,000. When we will reduce this amount by 12,000, the remainder is 0. So this means we cancelled out the common part. Now what about the remaining 6,000 which is here? This is basically goods in transit and this can be added into this inventory. So the inventory will become 60,000 plus 50,000 plus. We are just transferring this balance 60,000 to here. So this will give us 116,000. Then again, there is no adjustment in cash. So this will give us 10,000. And now we know that this 100,000 will appear over here against share capital. And this 100,000 will appear over here. And this will be transferred to the cost of investment account. How much? Have we acquired 100%? No, we have not acquired 100%. We have acquired only 64,000 out of 80,000 shares because each share has a face value of $1. So 64,000, can we have calculator? Divided by 80,000, so this will give us how much percent? Shyam, can you give me this calculator? Okay. So we shall prepare over here, because here is a minority interest as well. So I use another color to prepare here non-controlling interest account.
Will you please provide me the figures?
64 divided by 80.
64 divided by 8.
80.
80. Okay. So it's 0.8.
Okay. NCI. We are assuming here, like we are not using fair value model for NCI. So 80% of share capital will go here, means 64,000 will go here, and the remaining 16,000 of share capital will be mentioned over here. So we bifurcated it, this share capital between these two accounts. And then this 28,000, because all this belongs to the pre-acquisition period, because we acquired Pak company, acquired Saudi company on the date when this balance sheet is being prepared. So we will be dividing 28,000 again among these two accounts. So 28,000 into 80%, how much?
This comes to 28,000 into
28,000 into
22,400.
22,400. And then 20%?
5,600.
5,600. So this means we have accounted for this, we have accounted for this, we have transferred this to here, and similarly this will be transferred to the consolidated financial statement. Then there is a 10% loan of parent. We will mention that loan as it is
75,000.
75,000, and then there are payables 47,000 plus 16,000. This will give us 63,000. Am I correct? Okay,
Yes.
then 50,000. So no, this here you can total your, before adding all these figures, we need to calculate over here goodwill. What is the goodwill over here? Like 64,000 plus 22,400 minus 105,000.
64,000
Plus 22,400.
486,400 minus 10,500.
10,000, 105,000.
Okay.
So this will give us goodwill. So here you can mention goodwill. How much?
This is 18,500.
18,500.
18,500 is our goodwill.
18,000, just 1 minute, 18,000.
So, sir, what will be the NCI's goodwill?
Okay, just one. 18,600, because this is 400. 18,600, and this will become the NCI because there is no other entry. So you add these two figures, this will give you the NCI figure. So NCI will appear over here. Like if I change my color from here, NCI, we know that this is the part of the equity, but this will be shown as a 21,600. So NCI will appear over here, and now both assets and the other side should tally with each other. 21,600, and if we add up, so this will give us how much? 434,600. 434,600. Likewise here, 434,600.
The asset side will be 434,600.
Okay.
Well, let me recheck the calculations.
Okay.
63,000.
Very basic.
44,600.
Okay.
Yes.
Very basic. I hope it is clear. You can move to our next concept. Our next concept is number 8, suppose it's number 10, pre and post acquisition reserves of the subsidiary. So far our illustration was made in a way whereby we were acquiring the subsidiary at the date of statement of financial position. But in case if both dates are not same, you might have acquired a subsidiary maybe a couple of years ago, then there will be profits when you acquired that subsidiary, and after acquisition there will be profits. We know that we name those profit like pre-acquisition profits and post-acquisition profit or reserves. Pre-acquisition reserves and the post-acquisition reserves. The reserves which were lying in the statement of financial position at the date of acquisition, and those reserves which your subsidiary earned or accumulated subsequent to the acquisition. So segregate pre and post acquisition reserves. Use pre-acquisition reserve for calculation of goodwill. As in our earlier two illustrations, we used the whole retained earning of the subsidiary for the calculation of goodwill. Why? Because the whole amount is basically pre-acquisition reserve. Post-acquisition reserve, of course, if subsidiary is not 100% on and we are using partial goodwill method, then of course a part of that pre-acquisition reserve will be credited to the non-controlling interest as well. Post-acquisition reserve will be divided among parent and non-controlling interest. So let's have a look at another small example illustration, and that is illustration number 8. Suppose this is a small illustration. Okay, illustration number 8. As per illustration number 8, it says P company has owned 75% of the share capital of S company since the date of S incorporation. See, be careful. I'm going to launch a very small pop-up question related to this illustration. So be attentive and be with me so that I could be sure about your attention. P company has owned 75% of the share capital of the S company since the date of S company's incorporation. Their latest statement of financial position are given below. Statement of financial position as at 31st December 20x8, non-current asset, and then there are investment, and then you can see that prepare the consolidated financial statement. Okay, my question is if I just move this page down, this will show you the whole question is in front of us, only the requirement is not in front of us. So for requirement, the requirement is in fact prepare the consolidated statement of financial position. My short question for you is, like, what is the pre-acquisition reserve? Retained earning. See, here you can see that this is the total retained earning of S company. My question is, what is the pre-acquisition retained earning of S company? What is the pre-acquisition retained earning of S company.
Will you please give me the options?
Okay. Option is 10,000. Option 1 is 10,000. Option 2 is 35,000.
35,000.
Option 3 is 0. So the question is in front of you, as we are saying again and again that please download these handouts from GoToWebinar and from the Google Doc link we provided earlier, so that when the question is popped up, so you should be able to see your question at the same time. So have you popped up that question?
Yes.
Okay, fine. So please come up, participate.
Some participants are answering in the question form. I must recommend them to please participate in our poll, as this has been popped up in your windows as well. You can straight away answer there. You can submit your answer there from the available options. So far, 11% people have voted out of around 450 attendees right now. I don't know why such low percentage have participated in our poll questions. I must request to all the attendees to participate. So far, 14% people.
Please warm up yourself with these small concepts.
Soon I'm going to close this poll question, so you have to submit your answers right away. You have only few seconds left now.
Give them 10-20 seconds more.
Okay.
If they are reading that question, that's well.
I hope they have read. So should I close now?
Yes.
Okay, guys, I'm going to close this poll question. We have 42% people saying 10,000, while 20% people are saying 35,000, and 38% people are saying 0.
38% people are correct. See, from this I will be explaining the answer, but from this, I would request the rest of the people to participate. So this will help you to revise your basics, revise the basic concepts. It is not the case that we have passed our like exams, but clarity of concept will also help in your practical situations. So it is better, no problem. Making mistake is not a problem, but sticking to that mistake. How can you stick to that if you do not try to learn, if you do not try to participate? Because if you make mistake, only then you can correct it. So I would not discourage those people who made mistake. See, if we just look at the question, in the first line you can see that P company acquired 75% of the share capital of S company since the date of S company's incorporation. When a company is incorporated, that is the date of acquisition. At that time, profits are 0. When a company starts, profits are 0. Right at the start of the S company, P company acquired. So pre-acquisition reserve will be 0. 35,000 are not possible. So please be attentive. Be attentive. We are talking about S company retained earnings. So S company retained earning maximum, if we go for the pre-acquisition, it should be 10,000. But here in this case, the answer is 0. The people who answered 0, they are correct. But if you have any question, like if you want some clarification on this, so please feel free to ask while we are solving this small illustration. See here we have like this profit can be divided into pre and post, and if you just like here, pre-acquisition retained earning is 0, and post-acquisition retained earning is like 25,000. Sorry, this will be 10,000. This will be 10,000. So this will be further divided. This will be 10,000. I want to take this figure here to here. Okay. So when we prepare cost of investment account, if I use this space to prepare cost of investment account, and I need to prepare non-controlling interest account as well. Non-controlling interest account as well, and we are assuming that we are using partial goodwill method. See, if we start from here, we know from the question, we read the whole question. So simply we will add these two figures. This will give us property, plant and equipment for consolidated financial statement. This 35,000 will not appear in the consolidated financial statement. Rather, this will be transferred to the cost of investment account. Then we know there is no adjustment. So far as the current assets are concerned, we shall be adding them up simply. This will give us 80,000. Khyam, I suppose you are like double checking my calculations. So that there should not be any arithmetical inaccuracy. Okay, we know that in consolidated accounts only share capital related to the parent will appear. And what about share capital of the subsidiary? This will be transferred to the cost of investment account. Of course, 75% here. For
7,500.
How much?
7,500.
40,000. 75. No,
40,000. Okay.
30,000.
30,000.
75,000 or 40,000. This will give us 30,000 and 25% here in the non-controlling interest. So this is treated. We have treated this account. Now, this 25,000 will be added in the consolidated. And what about this? So this is post. Post will be divided between two accounts. NCI and consolidated retained earnings. Consolidated retained earning. For consolidated retained earning, parent profit, consolidated retained earning, parent profit will go to this account, consolidated, or you can make a statement, that's not an issue, like 25,000 will appear over here, and then this 10,000 will be divided between CRE. This is the CRE. 75% of 10,000 will appear over here, and 25% of the 10,000 will appear over here. So this means 25,000 is treated, and then 10,000 being post-acquisition profits, we subdivided this amount into between CRE and NCI. So from CRE, this will give us the figure to be mentioned over here, 32,500. And this account will give us the NCI
12,500
to be mentioned over here. NCI 12,500. 12,500. Let me make here.
And goodwill will be
instead of 3. It is basically
32,500.
32,500. And these are the current liabilities, no adjustment, 45,000. And then we calculate the goodwill.
5,000.
Goodwill is 5,000 coming from here. Here is the goodwill. Goodwill. So when we add up, so this will give us total asset
70,000.
170,000. And on the other side, this will give us
1,70,000.
170,000.
70,000.
So if we have any question, otherwise we can move. Okay, we are reaching people, and these are quite straightforward, like a small illustration just to refresh their basic ideas. But I would appreciate, please take advantage of these sessions and refresh your basic ideas, because your pop-up question give us the idea. I'm very sure the majority population who is not participating in this pop-up question, they are very clear on those concepts. But please prove this assumption. I'm very sure, not assumption, I'm very sure that they are very clear on these concepts. But to encourage us to like we are conducting this session, and our major remuneration from your side is your encouragement and your feedback. And participation in the pop-up question is one way of feedback. So please participate in the pop-up question so that we could get the good idea of the people participation. Okay. Now to the next concept, and the next concept is impairment of goodwill. We have seen this concept. Then impairment of goodwill. See, in case of impairment of goodwill, International Accounting Standard 36, impairment of asset, require that once recognized according to IFRS 3, goodwill is tested for impairment annually, or more frequently if circumstances indicate it might be impaired. Okay, so I have selected 4 small illustrations to like make you understand the treatment of impairment of goodwill. These illustrations are taken from complex questions and the complex situations. Though illustrations are small, but these 4 illustrations will cover almost all the aspects of impairment of goodwill. Okay, you have here illustrations. Illustration number 9. Here we have illustration number 9, very small illustration. Goodwill is equal to 500. Impairment loss is equal to 100. P company acquires 80% ordinary share and uses partial goodwill method. Partial goodwill method. What will be the double entry? Very simple. The double entry will be for this 9. Double entry will be debit consolidated retained earnings or group retained earnings. Consolidated retained earnings. This will be debit with $80, and your goodwill account will credit $80. The important point is, if you are using partial goodwill method, this means you have recognized only your part of the goodwill. You have recognized only your part of the goodwill. Though goodwill is in total impaired by 80, by 100, but you have not recognized the full goodwill. Had it been the case, you would have reduced that goodwill by 100. But because you partially recognize that goodwill, so you will be reducing your goodwill only for your part of impairment. And your part of impairment is 80% of the total impairment. So this will be the entry for your goodwill. This is illustration number 9. Now come to the illustration number 10. Come to the illustration number 10. See, here you can see that goodwill is equal to 500, impairment loss is equal to 100, P company acquires S company's 80% ordinary shares and uses full goodwill method. Required pass double entry for impairment. Here, because full goodwill method was used while recognizing goodwill, this means the goodwill recognized in your accounts include the share part of the goodwill related to the NCI. So here, because you have used the full goodwill method, so the total impairment will be reversed from your goodwill. So your entry will be for 10, your entry will be, I am passing this entry within this, no, space is not enough. So I am passing this entry by mentioning, like this is for like illustration number 12, because these illustrations are placed over here very closely. So your goodwill will be credit goodwill account with 100, and then debit group retained earnings or consolidated retained earnings. Consolidated retained earnings, and only your part, and the balance of 20% will be debited to NCI. 20. So this will be the entry for illustration number 10. While we are discussing illustration, we discussed illustration number 9. We discussed illustration number 10. While we are discussing the other two illustration, if you have any confusion, any question, or you want any clarification about this concept.
Nasir is asking for clarification in respect of partial and full goodwill method concept.
Adil, okay. I'm leaving this entry over here for the purpose of explaining what you said. See what happened. You recognize your non-controlling interest, controlling interest, by either of two methods. You recognize your non-controlling interest at fair value or not at fair value. Other name of it is when you say you are recognizing your non-controlling interest at fair value. This can also be termed as full goodwill method. Full goodwill method. And when you do not recognize your non-controlling interest at fair value, this is also termed as partial goodwill method. Okay, let's further discuss one by one what is full goodwill method and what is partial goodwill method. Okay. How can I move down? I can move down from here. Yes, from here. Okay, I can. Okay, I can use another page, but from this page that will be saved, like this is the situation. Okay. Now what happened next? If I choose another page because I'm facing problem in selecting another page from the same document. See, under partial goodwill method, when you initially at the date of acquisition, when you calculate goodwill, how you perform the calculation? See, this is cost of investment account, and this is NCI account. Here you will mention the consideration you paid. Consideration you paid will be mentioned over here, say it is AAA. Now, against this consideration, you acquired, say, 80% of the share capital of the subsidiary. So, under partial goodwill method, what you will do at the date of acquisition, you will subdivide the share capital. Say we denominate it with small s, 80%, the percentage of acquisition. So this will give you some figure. And similarly, 80% at the date of acquisition will be transferred over here, mean S share capital into 20% will be here, any figure. Similarly, pre-acquisition reserves, including retained earnings, say we denote it with R, 80% will fall over here. This will give you this figure. And similarly, 20% of those reserves will be credited to the NCI. So this will give you the. Now, thereafter, NCI will be further credited with the post-acquisition reserve, any other adjustment this way. We are not discussing it further. We are coming to the cost of investment account, from where we will be calculating the goodwill. Assuming this is the positive goodwill, so goodwill will appear over here. Goodwill will appear over here. Say we denote it with triple B. If you note here, of course, after making these two same account for full goodwill method, then we will be comparing these two things. But for now, my comment is this is the consideration for the acquisition of 80%. And you have mentioned over here, you credited over here 80% of the net asset acquired. So this will give you the goodwill on this 80%. So that's why it's named as partial goodwill method. You calculated only your part of the goodwill. Now let's see the other method. There you will see what is the difference. Okay. If you go to the full goodwill method, full goodwill method, or when your NCI is at fair value, full goodwill method. See, again, your account of cost of investment, cost of investment account. And you can apply the same approach in the statement form. That does not make any difference till the time you are clear which amount will be added and which amount will be deducted. That is not an issue. NCI account. Same situation, you acquired 80% consideration. Of course, the same consideration as we mentioned above. Same consideration you paid. But company is using full goodwill method. Now what will happen? Above, we divided the net assets of the subsidiary between this account and this account. Now what will we do now? The 100% net asset of the subsidiary will be credited to this account. We used the word S for share capital. This means the S will appear here, 100%. Similarly, all the effects of the pre-acquisition retained earnings. Above, we divided this pre-acquisition reserves denominated by R between this account and this account. But now the total amount is being credited to the cost of investment. Now what happened to this? What is the treatment for this? We will calculate here the fair value. We will calculate here the fair value of NCI. What is the fair value of NCI? Normally, fair value of NCI normally is equal to number of shares, related to minority, number of shares, minority. Like you have acquired 80%, so this means 20%, but number of shares into fair value of each share. This will give you, say, capital C. So what we will do, we will pass an entry. See how we have calculated fair value of NCI? Fair value of NCI is equal to number of shares related to the minority. Here we have acquired 80%. This means number of shares which represents 20% into fair value of that share, mean market price of that share at the date of acquisition. So this will give you, we have denominated it with C, the fair value of the NCI. So what will be the entry for that? Here we will be mentioning this C, and that C will appear over here. So the entry will be cost of investment debit, account debit with the fair value of the NCI, and NCI account will be credited. Now, subsequently, what happened to this account? Of course, subsequently, post-acquisition, retained earning, reserves, or other adjustment will appear over here. We are leaving this account here, as we did in case of partial goodwill method. We are going to discuss this account. Say there is a positive goodwill. Now, the goodwill will be, say, triple T. You can note that here is 100% of the subsidiary. Here is also 100% of the subsidiary. This is the amount which you paid, and this is the amount related to the minority. So this goodwill is full goodwill, not partial goodwill. Whereas on the first method, if you go back, you can see that here you have only taken your consideration. Here you have only taken your consideration and only your part of the net assets. So that's why this is termed as partial goodwill method. Partial goodwill method. Who was this gentleman, Khyam, who asked this question? I just want to make sure, is it clear now? So that I could move further.
This question was asked by Adil.
Adil, is it clear now? I mean, this is the partial goodwill method, and this is the full goodwill method. Now see, in your account, if you're welcome, if full goodwill is there, this means if we go back to the illustration number 10, we can see that in illustration number 10, because full goodwill method was used, so the whole goodwill is lying in our account. So we're reversing the whole amount. But second effect will go to the CRE and NCI. But in illustration number 9, because we recognized only 400, we have not recognized 500. 500 could be, we have recognized only 80% of the 500. So that's why when we will be including the impairment loss effect, that will also be 80% of the total impairment loss. Okay. Now, before moving to illustration number 11, we can have a short break.
I request to all attendees to please send your questions, submit your questions during the break session. So we will quickly move on to the answering session after the break will end. I hope you get my voice. You guys have around 6 to 7 minutes for submitting your questions. Okay, so we received a question from Mr. Saqib Ali Rashidi, Quran Book team. We will get back to you. In the meantime, we have another question from Muhammad Imran. So far, only 3 questions left for trainer's answer. Yes, we will be having a break for prayer. In the meantime, those who are not willing pray, they can submit their questions. We will be answering other questions, but the answers will be on first come first serve basis. Those questions who will be submitted earlier, they are going to be answered. And I must request to all attendees to please submit their complete question in one go. This announcement has been made time and again. So I think those people or those participants who are sending their question in bits and pieces, please, it's a humble request. Try to understand that we have lots of questions and we cannot consolidate your question. Rather, I must say this is a topic of consolidation, so you can understand how tricky is the consolidation. Thank you so much. So we are having some questions from our audience. Let's get back to them. Will the goodwill be transferred to group retained earning and non-controlling interest by their shareholding ratios under the full goodwill method? Sakib Ali Rashid.
Sakib, yes, you are right. Next.
Okay, which method is recommended by IS? Full or partial? Mohammed Imran.
Mohammed Imran, you can, this depends on your policy. Both are recommended. That's not an issue of recommending. You can apply any of these two methods. Next.
Burhanuddin. If the property, plant and equipment of subsidiary are measured using fair value method, how it affects value of fixed assets at the time of consolidation?
The only effect is if your property, plant and equipment are already at fair value, you need not to redetermine the fair value, because Burhanuddin, you know that at the date of acquisition, even if you are not using fair value model for your property, plant and equipment, you calculate the fair value of those property, plant and equipment for the purpose of calculation of goodwill. So that will give an advantage that that value is already there.
If the consideration paid by parent to acquire shares of subsidiary is not fully paid at the time of acquisition of other elements other than cash, how it affects the calculation of goodwill?
Who is this?
Burhanuddin.
Burhanuddin, we are going to discuss this point. I mean, you are talking about deferred consideration, and of course, we will be covering deferred consideration and other type of considerations as well. Next.
Sakib Ali Rashidi saying that he cannot hear us, but I think all the attendees can hear us right now. So
Can you please just tell us, can you people hear us? Because we
People can hear.
received a feedback, someone is not able to hear us. So please just quickly tell us, can you people
yes,
hear
people
us?
are saying Fateh
Okay.
Fakri, Burhanuddin.
Okay, thank you,
But
Fateh Fakri.
I think Sakib must be answered once again. Sakib has asked the question, will the goodwill be transferred to group retained earnings and non-controlling interest by their shareholding ratios under the full goodwill method?
Yes, Sakib, you are right.
Okay.
Okay, now we can move to the illustration number 11. Illustration number 11 is okay. At the year end, an impairment review is conducted on an 80% owned subsidiary. At the date of the impairment review, the carrying value of the subsidiary's net asset were 290, and the goodwill attributed to the parent $340. I mean, of course, these are in millions. And the recoverable amount of subsidiary is $675. Now, 9 and 10 was for the basic concept. Now, this is a practical situation. Of course, those are also practical situation, but those situations are quite straightforward. Now, this is the situation whereby your whole subsidiary is impaired. Note, goodwill was calculated using proportionate goodwill method or partial goodwill method, or the non-controlling interest was not at fair value. All these are one and the same thing. Required. Calculate the following: impairment of goodwill, amount of goodwill to be shown in group financial statement, and the journal entry. We need to perform three things over here. Okay, first of all, we will calculate the amount of goodwill. See, the amount of goodwill is what are the subsidiaries' net assets? Subsidiaries, because what is the impairment loss? In fact, impairment loss is in fact the difference between the carrying amount and the recoverable amount. We know from our earlier lecture from International Accounting Standard 36. It is the difference between the carrying amount of that particular asset or a cash generating unit. In this case, it is a cash generating unit, and that cash generating unit is our subsidiary. So first of all, we will calculate the carrying amount of subsidiary net assets. So subsidiary net assets as given here in the illustration. You can calculate from the balance sheet total assets minus total liabilities, net assets, of course at fair value. Now, what is the goodwill? Goodwill attributed to the parent is 340. Attributed to the parent 340, what does it mean? This is not full goodwill. This is only part of the full goodwill which relates to the parent, mean 80% of the full goodwill. If we want to calculate what is the full goodwill, we will gross it up with 0.8. This will give us full goodwill. This is 425. Yeah, please help me in ensuring that our calculation is correct. So this is full goodwill. As we have seen in case like illustration number 9 and 10, I have already provided you the full goodwill value. That was 500, full goodwill value. This is 500. We know from ISA 36, while calculating the carrying amount of the cash generating unit, which is in this case a subsidiary, we shall be adding the goodwill related to that subsidiary. Here just remember, always add the full goodwill, because right now we are only calculating the impairment of this subsidiary, of this cash generating unit. When I say cash generating unit, this cash generating unit is equal to this subsidiary. In fact, we are only interested in that, and we will be taking the full amount of these. Okay, so this will give us the carrying amount 715. This is the carrying amount of this cash generating unit or this subsidiary. Now we have been given the recoverable amount, and that recoverable amount is for the whole subsidiary. It is already provided to us. Recoverable amount. Practically, we can use the guideline given in International Accounting Standard 36 to calculate this recoverable amount. This is given as 675. We can see that recoverable amount is lower than the carrying amount. So the difference between these two figures is impairment loss. Impairment loss. And that is, what is the difference? Please calculate.
40.
No.
715 minus 675.
75, yes.
40. 40.
40.
Yes, 40.
This is the impairment loss. So this is the answer of requirement number A. Okay, now move to requirement number B. So let me convert it to like here. I should mention over here. Actually, it is difficult.
Highlighted.
No. Actually, I need some space here, but it is difficult to. Okay, I think I can make some.
Just drag your.
Okay. I will.
Mouse
Yes.
Yes.
This way I can make some space over here. Okay, fine. No, I have some space. I think we should save the way, with the material which we mentioned over here, so that it is beneficial for the participant, so that they can.
You want me to post it over the Google Doc link.
Yes,
Yes.
but just after that. Okay. See, the second requirement is amount of goodwill to be shown in group financial statement. So this is the total impairment loss. Okay. And in group financial statement, what is the loss? And our recognized goodwill, how much is? Our recognized goodwill is given in the illustration. Recognized partial goodwill. We know that this is the partial or proportionate goodwill, and that is $340. You can see from top here. It is given in this question. Like partial goodwill is 340. Fine. This is the 340. Now we shall reduce this goodwill with the impairment loss. But impairment loss, as we saw in case of illustration number 9 and 10, 40 is the total impairment. 80% relates to this partial goodwill. So 32 will be reduced to reach to the figure of 3088. This is the goodwill to be shown. Goodwill to be shown in group statement of financial position. We calculated the impairment on a cumulative basis because we need to calculate the carrying amount of the that subsidiary, that cash generating unit as a whole. So we grossed up the related goodwill amount and then compared it with the recoverable amount. This is the method you will be applying if any of your subsidiary, any of your cash generating unit, you have any doubt about the recoverability of that subsidiary, recoverability of cash generating unit, while in fact you are using the partial goodwill method. But for the calculation of the impairment loss, you will forget about your partial goodwill method and you will calculate your impairment loss on a cumulative basis. But when it comes to the application of that impairment loss, of course, that will because you are using partial goodwill method and only that part of the impairment loss which is related to the group will be accounted for. Okay, now the requirement number C is journal entry. What will be the journal entry for this? Journal entry is simple, as we know from our earlier illustrations, like you will debit consolidated retained earning account with 32 million, credit goodwill account 32 million. So this was the illustration 11. So tomorrow we shall continue, and meanwhile I will ask Khyam Lodi to pop up the feedback question, and this is all about from my side, and thank you very much for your constructive participation. Though at the start feedback was not very encouraging, but subsequently people started participating on realizing that they need to refresh it. See, if you cannot make score in a small street, you cannot score good in big ground. So all these practical scenarios are basically an offshoot of or a larger picture of these small concepts. If you are very clear on these small concepts, you will be very comfortable while applying these concepts to the larger practical scenarios. Thank you very much. So have we popped up?
Yes, we have popped up, and around 1 minute have already elapsed. So how much
Please,
time do you
please.
want me to?
Just for 1 minute and then you can close it.
Okay, guys, we are left with few seconds. So you have to submit your answers right away, as I am going to close this in a bit. I request you to please submit your feedback as soon as possible. Okay, so should I close now? I think I should close it now.
Okay.
Okay, so we have 40% people saying excellent, 44% people saying very useful, 16% people saying good, and I don't know 1% I think only 1% is saying below average.
So that one person, if you can provide us feedback, like how can we improve? What are your ideas? You might have attended some other session. If you like for like giving the same concepts, what could be the other useful methodologies? And we will be very thankful for your feedback. And for the rest of the people, thank you very much for your feedback.
I request to all the attendees to please participate in one more poll question that is regarding your currently residing country.
Yes, please.
Okay, so we have our poll question here. This will give us the idea that how many people are people attending from which sort of region or which sort of country. So those guys who are saying other, they must write in question box or chat box that which country they are actually residing. Maximum number of people have voted for this poll. I think people have more interest in this question. So only 20 seconds left now. I will be closing this question. I think 10 seconds left now. Okay, so I am going to close this question. So we have the statistics. Around 45 people, 45% people are from Pakistan. Similarly, 45% people are from Middle East.
Good.
1% people saying that they are from Sri Lanka. 3% people are saying Bangladesh, and 6%, the rest of the 6% are saying other.
Okay.
So I think they must write in questions box. Yeah, we have some people saying from Qatar, Afghanistan, Canada. Saad Umar is attending this webinar from Canada. Thank you, everyone.
And thank you from my side as well. And we will continue. We will continue this session. And tomorrow is the last session for consolidation. Thank you very much.
Thank you, everyone.